At the end of the day, the principle there is you can't claim two main residences at any one time. If that 6-year period lapses without you selling or moving back in, then does that mean you don't get that main residence exemption at all on the investment property? The typical property, you'd hope to achieve 5% minimum ongoingly over 10 years, 20 years, 30 years. 5% growth is what we're trying to achieve as a conservative growth rate, consistently achieving 13% every 4 years, changing over and getting the 13% average over the next 4-year period, and then changing over, getting the 13% over the next 4-year period. Why do we have to sell this property? Can we refinance and pull the equity out and make use of that instead of potentially selling and staying in the market longer than for your rents to compound and your overall price to compound?
Welcome to Perth Property Insider, where you will learn how to grow your wealth and improve your life using Perth property. Our show is brought to you by Investors Edge Real Estate, the highly rated and award-winning property management, sales and buyers agency servicing the whole of Perth. Now, here's your host, Jared Mann.
G'day and welcome to another episode of Perth Property Insider. Today, I've got Ashwin Ramdas from Exemption Group, my go-to for accounting and overall tax strategies on the show. Thanks for joining us again, Ash.
Thanks, Jared. Thanks for having me. Good to join your listeners and hopefully we can share some experiences with them.
Yeah, awesome. Well, I'm getting a lot of people, because we're heading up to the end of 30th of June, and I'm always asking myself big picture when I'm chatting to people, what are the strategies we can take to get the very best price for someone's property when they do sell? But a big part of that is also looking at what they're left with after tax. So it's no point planning your home upgrade or expecting that you're going to end up with certain amounts if you haven't thought about what your take home is. And so that's why I wanted to get you on, because there's a number of factors that can come into this, I guess. And having that exit strategy clear from the start, avoiding some of these tax traps and understanding, I guess, the timing for your payments is just as critical. So, do you find that investors often focus on that price but forget about their tax?
Well, not to harp on about it too much, but everyone gets caught up on the sale price. Like, it is the exciting bit. If you get the best price, you're walking away with the most dollars. And that's true definitely for most of the time. But I suppose there's the common things that people forget about is the timing of the event. And, perfect time, we're getting close to the end of the financial year, and people go, oh, well, I didn't sell it till the next year because it only settled in August. Well, the tax office works off the offer and acceptance date. So if you sell it, sign the offer and acceptance, and it's executed by both parties before June, it means it's going to be caught up in the next financial year, which if you're not using a tax accountant will mean end of October, and you're going to have to pay the tax bill on the property. Hopefully you made some money, you're paying some tax on it. Well, if you just had a word to your agent and said, hey, we're going to hold off and sign off this in 1 July or next financial year, you buy yourself an extra 12 months before you have to pay the tax bill you otherwise would pay. So that's a big saving, and it also gives you more time to plan on what you're doing with the fund. So the tax bill and the investment and what the next stages are. So especially when it gets really close, when we get into that month of June, not to sink anyone's commissions or timings on stuff, but just the offer and acceptance, if you can push that out to the next financial year, that extra timing of 12 months is significant for a lot of people.
And at least when we know that, I've had a number of clients come to me, we've laid out the strategy, we've looked at how the tenant's presenting, we've looked at the lease end date. Usually we would vacate the tenant if it's not presenting well. In one of the cases at the moment, the client's gone and chatted to their accountant, and it's going to be a 40 or 50K sort of difference overall in their situation. And also the they can defer the payment an extra year. So in this case, I've sort of said to them, hey, the tenant isn't presenting well. This is not one that we manage, unfortunately. So we haven't had control. I'm coming in, blind, and we're walking into a bit of a mess. And so the lease doesn't end until September. And I've said to them that we're probably going to cost ourselves 30 or 40K, probably on the 30K. And I like to be fairly, I'm trying to sort of overestimate, because when you get buyers really emotional, you can get an emotional price, but hard to get emotional when property's not presenting well and we've got a tenant fixed lease until September. So I'm really only going to be dealing with investors, because home buyers will want to move in. They won't be prepared to wait. And so I've really factored in and tried to give them an estimate for how much this is going to cost. And then they can go away, chat to their accountant, work out the tax saving benefit with their overall situation and the timing benefit of delaying it 12 months. And they've come back and said, hey, I think the lesser of these two costs is to get it sold in this financial year. So that's what we're preparing to do and put it on over the next week or two, with still trying to present it as well as we can with the tenant, but understanding that there's going to be some trade-offs in the price that we'll get. So at least we can, have the strategic chat about what makes sense, rather than just, oh shit, it's sold now. It's too late. No, nothing we can do once it's sold, is there?
No, and I suppose my only concern with potentially what's happened there is obviously the timing of the sale. If you manage to get the offer and acceptance before this side of the year, they might not have the timing to make the tax strategies around, super and all the other contributions we'll talk about later. And, they've left themselves a bit short. So I'd be interested to understand how detailed that was. But, each accountant would know what circumstances for their client. So, yeah.
So take us through some of the understanding of, capital gains tax basics. Like, what do we need to know when it comes to CGT?
Yeah. Look, when it comes to property and CGT, it's generally the same rules for all assets, but probably the thing that's special about property is the main residence exemption. And in short, that basically means the house that you principally live in, when you sell it, you won't pay any tax on it. Now, that is subject to it not being more than 2 hectares. And there's been times when people didn't know that.
Yeah, I didn't even know that one. So that's a new one for me.
So the 5 acres or 2 hectares is the general test. So some people get caught out when they sell their big block and they find out there's some capital gains to be paid. And the only way around that is if you manage to own that property before 1985, then yes, potentially you don't pay anything at all. But otherwise, that 2 hectare rule applies. So there are times when that gets caught up, but it's the only place where there is that main residence exemption. So you don't pay any capital gains on the main house you live in. Investment properties, on the other hand, are like any other asset. You'll pay tax on the profit you make on selling it, but that profit, if it will be halved by 50% if you own it for more than 1 year. So that's probably the most common strategies. Where it gets a little bit complex is when people have granny flats on their houses and they rent those out at commercial rates, and they move out of their main residence and buy another house and they keep that one as an investment property. So there's a partial main residence exemption, and valuations and apportionments is where that gets a little bit more complicated. But
so can you explain that sort of 6-year rule? Because that seems to come into people's planning a fair bit. And I often don't know, do they have to move into it before the end of the 6 years? Or can they, if they sell it prior to that time period being up and they haven't claimed a main residence somewhere else, can they still claim that there, or do they have to move in? What's the go?
Yeah, look, the general principle to reset the 6 years, you would move back in.
Oh, so that's for resetting, to move it in. Okay.
To reset the 6 months. So look, the 6-year rule would apply normally on holding the property, as long as there's no other main residence claimed during that period. And that's where people sometimes get caught out. We've had people come in thinking, oh, we'll just move back into this investment property and it's been less than 6 years. I'm like, yes, but you lose the exemption on the other place, and that's not how it works. So I think that's probably the most glaring thing that sometimes gets through people on Google or the backyard chats, is probably not understanding that it's only one main residence at a time, which makes sense. You can't really live in more than one place at one time. Where it gets a little bit complicated is when 2 people had properties prior to being a couple. I mean, it's just finding dates around those dates and then getting valuations or apportionments based on the days if we can't get valuations at the time they moved into their new house. So it is more and more common that people are in their own independent ways and then they meet. So that first tax meeting is always an interesting one, where we go through all these little gremlins, I sort of call them, and we sort of plan for them ahead of time and go, what would we do?
I guess at the end of the day, the sort of principle there is you can't claim 2 main residences at any one time. And if that 6-year period sort of lapses without you selling or moving back in, then does that mean you don't get that main residence exemption at all on the investment property?
No, you still get the 6 years up to that date, but we'll want a valuation, or we want to use the days apportioned for that.
Oh, great. No, well, that is fabulous to know, because so many times people say to me, oh, Jared, I'm thinking of selling this property now so that I can get the 6-year rule before it, gets you, before we lose it.
You don't lose it altogether.
Oh, that's good. You just index it from that point onwards, I'm gathering.
We get the valuation or the days. But I suppose the thing is, if they bought another place, they won't have main residence for the 6-year period of the other house.
Yep, true. Where this comes up is often they haven't yet bought another place, they're renting. They think, oh, should I have to sell it right now? Otherwise, I can't get the benefit of the 6 years at all. I say go chat to your accountant and firm it up. But, the reality is a lot of people don't.
Yeah, well, definitely always worth checking this the 6-year rule with an accountant. The other part is obviously main resident. If you're no longer an Australian resident, there's a whole bunch of CGT rule changes for them, which is very tricky, and there was a lot of the benefits have gone for them. So it's a very tricky situation for those non-residents anymore.
Okay, no, that makes sense. Okay, well that's good. I've learned a fair bit there. This is why I get you on the show.
More than happy to.
Excellent. So what are some other things to, I guess, consider when you're planning ahead? And this is where people can get caught out a bit, I think.
Yeah, look, I think the first part is obviously let's go through that situation, and you've sold the property and you've made fortunate enough to make a nice capital gain as a family or, as a couple. How do you plan for that tax bill? So,
well, thankfully, many people are sitting on very decent equity now, and I'm seeing very good gains, and it's nice to have a podcast on how to handle your gains, Ash, instead of
I think maybe a few years ago, maybe the same sort of conversation, but definitely a lot of equity in the property market in Perth. And look, when they sell, the things we'd probably look at most commonly is the catch up on the super contributions, which might not have been used up in the previous years. And that's basically a system where the ATO, or the government's created a situation where you can catch up on any of your contributions you haven't used in previous years on the basis you've got less than $500,000 in your account and you haven't used the maximum over those period of time. So that's probably the first place most accountants would look at, any of your listeners could log onto their MyGov account and check their balance on there, and I'll double check with their super fund and see how much extra they could put in. The other one is if you happen to be selling your principal place of residence and you happen to be over the age of 55, there's some downsizer contributions where you can put money into super. Obviously, you're probably going to buy another house to live in, and the excess funds, subject to the ownership, you could put up to $300,000 per person into the super fund each. So you'd have to make a healthy game to do that, but it might be in your interest to do that because super is a great place for investments, but you do need to go through quite a few checks there. So I'd engage a financial advisor to go through those checks and see you qualify for it. But it's a great way to put more money into super at the stage where you're probably towards the end of your closer to retirement. So for a lot of downsizers, that's definitely an incentive to put money in there, and it's a good thought process.
When that goes in, does it go in tax-free or at a lower tax rate?
Goes in tax-free. So it's just it's a non-concessional contribution similar to the normal non-concessional, but it's extra gap. You've got a cap you can use. So great for people to do when they're in that fortunate position they've got excess funds from their main residence. So great tool for most people to do that. But you do have to think from memory, you have to put the money in within 3 months of the settlement.
Just real quick before we continue on with the episode, are you getting my email updates yet? If you're not, you're missing out on our suburb intelligence reports, which we tailor and prepare for your individual suburbs of interest, showing advanced stats and insights. Must get onto those. And I also send out exclusive invitations to our events, including webinars, sundowners, and workshops. So if you're not getting those, head on over to investorsedge.com.au/join and make sure you're receiving my email updates.
I guess that does make it a little trickier if you haven't bought your place, but a lot of people try to make their offer subject to sale or minimize that time period anyway.
Okay, I imagine downsizers are probably want that peace of mind of settling on their new place.
Yeah, having somewhere to move, not doing a double move. Yeah.
Probably the one thing, just for anyone that's trying to do things, it doesn't include a caravan or your motorhome or things like that. If you say that's where you reside, it is a house. in the legislation.
Okay, so it's an actual requirement for you to purchase your next place.
Oh no, you don't need to purchase. I don't think you need to purchase the next place, but you can't sell your caravan and say that's your contribution to your downsizer. So that is just a few.
Your actual residence sale.
Yeah, actual residence has to be sold.
Okay, cool. So when things get a little bit more complicated, is there any other advice on structuring your exit?
Look, I think like any asset sale and property is usually a very significant part of someone's portfolio or strategy. There's probably that reset of how do you rebalance it? Do you buy another one? Is that part of your strategy? So all of these things, when you sell a big chunk of anyone's portfolio, I'd say it's to sit down and a plan and a re-strategize post-tax contributions to work out what it is. And we sort of find clients will probably take advantage of those super contributions that they haven't used in previous years. On the basis they do that, all of a sudden their super funds have a decent balance in it. There's probably a reset around that strategy to line up with the overall strategy as well. So it's a good reset point, and generally people will want to do that.
I guess look at what they've then got in super, look at what is remaining in their portfolio, do a bit of other planning as to, when they might need other assets sold, which is a classic one. So we're often spacing out our sales of the properties, which is the chunkier, bigger assets. And a lot of people I tend to see using super earlier in their retirement or their transition to retirement, sort of keeping the property compounding for as long as possible, and then, selling these chunkier properties when they can, and, spacing the sales out, not to be in the same financial year to kick them up into higher tax brackets and defer those gains as well for longer. So
yeah, there's definitely that deferral to when the income's no longer in from wages or employment. There's definitely that strategy. We also have some people still want, obviously, property as part of their strategy, so they've now transferred that into, they've bought property in super, and that sort of negates the timing issue as much because the tax in super is lower. And then all of a sudden they're probably selling properties based on performance opposed to a timing of the tax hit, which probably is an incentive from an investment mindset. You're selling when things are at when you believe it's the right time to sell.
And I guess if you've got a good asset and you've got borrowing capacity and your time horizon's still a while off, so you're comfortable with any holding costs that property has, and I guess holding costs of other property that you might buy. I always encourage people to, hey, why do we actually have to sell this property? Can we refinance and pull the equity out and make use of that instead of potentially selling and staying in the market longer than for your rents to compound and your overall price to compound, and hope maybe get through another cycle or two before you sell and actually control a larger asset base instead of reducing it.
Yeah, those are all great reflection points for people to take in mind. And it's always just that bigger picture of just taking a step back and asking the why, and the capacity to do it. And, because transaction costs obviously are significant if you buy another one later. And it's always, is there a reason why you do that? And maybe it could be because you're down on one's income or something like that. And then there's probably a reason, but otherwise, you probably want to look at what the exit costs really are, and it's worth exiting on that basis.
Well, yeah, speaking of changeover costs, I often see things do get a bit tight for families, especially when they go through the one partner on maternity leave. It's nice if before we get to that point, we can have a bit of buffer and plan to get through those periods, because I had quite a number of discussions with people just before this most recent growth phase. And they thought, yeah, we'll go a bit tighter. We'll draw on some of those buffers that we have. And, now they're 200, 300, 400 grand better off because they held it and got through. And once your partner starts getting back to some part-time work to then transitioning to full-time, it's all of a sudden a lot more affordable again. So great if you can keep it and ride it through, but also understand that what you're going to be left with if you do sell. And then if you come back in the market later and have to pay those entry costs after you've paid your tax as well to get your selling cost to get out, your tax to get out, and then your entry cost to get back in again, it significantly increases the return that you then need to achieve for the rest of your investing life.
You definitely would only be doing that unless you thought that asset or that particular asset had reached a peak and you've gone into something else that you think is going to outperform that. Otherwise, you're right, those transaction costs are significant, and timing wouldn't really make much sense unless you're on a winner.
Well, I've done an interesting study, Ash, that the typical property, you'd hope to achieve sort of 5% minimum ongoingly over 10 years, 20 years, 30 years. 5% growth is what we're trying to achieve sort of as a conservative growth rate. And I've worked out that if you sort of chase the cycles and change over every 4 years, and you might not even be chasing the cycles, but circumstances wise, be doing that to get some extra money out to upgrade your home, or extra money, or things get too tight at certain periods and you're having to get out, the actual return you'd need to offset all those costs at a 30% tax rate, and it'd be even higher return you'd need if you were on 47 cents in the dollar, or higher overall rate. But you'd need a 13% return compared to the 5% return, and it's a significantly higher return, and you need to that's a consistently achieving 13% like every 4 years. So changing over and getting the 13% average over the next 4-year period, and then changing over, getting the 13% over the next 4-year period. So very significant, that's nearly a 2.5 times return just to account for buying, selling, and tax.
Yeah, the tax and the stamp duty and the holding, those transactional costs are significant each time, and it's not a cheap asset property, so it would be hard to keep recovering that if you keep getting in and out of the market.
Well, let's face it, it's a lot of effort as well with coordinating it all. I try to make it as simple and easy as possible, like for any seller, once they get to that point, and have a really smooth transaction. But it is still mental effort every time you go through a transaction, even if you've got a really great sales agent, and then they've got the effort of doing their taxes with you. So
it's a fun cycle. Look, I'd prefer clients holding things longer and making sure it's the right investment, because a 4-year horizon's pretty short for an investment mindset, I would think. But yeah, longer time gives you more time to ride both ups and downs all the way through.
I mean, that's a good point, that the only time I sort of see it being relevant, unless you absolutely need the money out for your personal situation and your overall plan, is if you've bought an inferior property and you've now discovered that. If you're learning all the time, sometimes we look back at our investment choices, and I think anyone that says they haven't made a mistake with investing is probably because they haven't done anything.
Yeah, mate, but look, I've learned heaps.
It shows how far you've come when you look back on them, doesn't it?
Yeah, it does. It does. Yeah, you learn from those experiences, and you try and pass it on to mothers so they can learn from it. And there's definitely some stuff I'll pass on to my boys when they get into the market on things to look at a bit more detail than Dad did.
I mean, it's just nice if you can get it right from the start, because as we see with those changeover costs, you'd still then need to go and achieve a much higher return to make that changeover worthwhile, is what it comes down to. So unless you're getting, I think, tenant headaches or other hassles that are prompting you, cutting into your personal world, cutting into your cash flow greater than you'd want as well, can be other good reasons. And it will start becoming harder to rent certain properties and sell certain properties later. So if you're going to sell, it does make sense to do it when the market's still reasonably hot, so that we can get a emotional price still. Whereas when the bottom falls out of things, can be very hard to find a buyer for some of those negatives that exist.
I'm going to say yes. There is, and I think that comes back to that horizon of where you are in your stage and what you're trying to achieve. And if you can see that maybe happening before you think the next cycle would ride out, then probably it is worth engaging to navigate that now. But like most investments, I'd imagine property is a long-term asset that you're going to be holding, so you want to be able to map that out.
Well, definitely worth speaking to your accountant before making any big sale decisions, and including that in your planning for timing. And if you don't have a good accountant, I'll put your details in the show notes to reach out to Eventum, and you sort of can probably help people that, already have a few properties under them, and, especially business owners as well. I know you love that sort of complexity, and it can add a lot of value to people in that space. And you also deal with the sort of self-managed super fund space, I think, as well. So
Yeah, it's definitely, I love helping people on their property journey, and understanding their goals, and just sort of being a sounding board at times and putting them in touch with others when they need it. But it's good to just see people grow and invest.
well, that's why I keep getting you back on, Ash, because I know that how you help your clients instead of just selling them a whole bunch of structures and products and crap that, only benefits the accountant, which we've both seen over the years. And
Yeah, I've seen it, and the problem with selling structures and complexity is you got to do the work, and no one really likes doing work unless there's a need for it. Well, that's how I operate, and the guys with us. So, but some people like selling the spider diagrams coming everywhere and everywhere. But
awesome. Well, thanks for coming on the show today.
thanks, Joe.
Listeners, if you've enjoyed this one, share it with your friends, like and subscribe. And if you feel we can help you with a strategic sale, get in touch. I sell properties a lot for our landlords, but I've also got a lot of clients that I help that might have their property management with someone else, and they're just not taking a strategic approach. Normally, when you chat to a sales agent and ask them about selling, their answer is now, and let's put it on the market. Whereas I'm looking into, what are all these many layers that we can do and tweak to get the very best price possible. People have done very well in the last few years. A lot of investors are pulling out of Perth from over east, and I'm talking a lot of people out of it, and also just reminding them of that returns they'd need to achieve elsewhere. But when it makes sense, you want to do it for the very best price possible, because the difference can be huge in the end outcome if we take it strategically instead of just chucking it up for sale like a lot of the local agents tend to do.
I think what I really like about Jared, how you approach it, is you look at it from that point of view. It's a transaction as sell. So you'll engage with the other advisors, get the client as the center, and work out what's the best outcome. And not to toot your own horn too much, but it's very rare for me to see that in the industry. And that care is noticed, and you can see people gravitate towards it. And this podcast is a great forum for creating those conversations and people to learn.
Awesome. Well, thanks, mate. I'll
Thanks.
catch you again on the next one, and see you in our mastermind group soon.
Just a reminder, the information discussed in this podcast is general in nature. As we don't know your specific situation, you should always seek professional advice before taking any action. For free market reports on your suburbs of interest and other helpful resources to grow your wealth, make sure you join my property investor update at investorsedge.com.au/join. And finally, make sure you're a member of our Perth Property Investment Facebook group to be part of the conversation with other like-minded investors, get help to your questions, and get a feel for what's going on out there in the market. I'll see you in the group.